Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. PayPal has confused a lot of investors over the last couple of years. The stock continues to drop, but this looks like a value stock, continues to churn out free cash flow, has a very solid position in the market. And I think the question now is this a buy just based on a value basis? So I want to dig into the company, what we're getting as investors, and maybe even some red flags to talk about. There's a lot going on here, and there's no perfect answer with PayPal, but I think it absolutely should be on everybody's radar. My name's Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. I'll just start here with PayPal's market cap and what the stock has done over the past year. You can see the shares are down 32%. Current market cap is $69 billion. So that's kind of the baseline on how to think about this business. These are some highlights from the most recent quarterly report. You can see that revenue was up 7% on a spot basis and 8% on a currency neutral basis to $7.3 billion. Total payment volume increased 11% to $377 billion. That's a key metric that the company reports. There's a lot going into that, and I'll dig into some of that. The company is also controlling costs. Non-transaction related expenses were down 11% year over year, and that meant operating income expanded on a non-GAAP basis by 2.3% to 21.4%, and non-GAAP earnings per share of $1.16 grew 24% from a year ago. I talked about that cash generation, what management is doing with it. Returned $1.5 billion to shareholders through purchases and $4.9 billion on a trailing 12-month basis. So buybacks are going on at a very rapid rate. And one of the things is management was buying back stock at a higher stock price. So as we often see, the timing on these things is not very good, but at least they are using some of that money to buy back stock. On a guidance level, management said that fiscal 2023 guidance of at least a 100 basis point increase in operating margin was reiterated in a 20% non-GAAP earnings per share growth to $4.95 per share. So about $5 per share. That means that shares are trading at about 12 times non-GAAP earnings per share right now. These are the general high level numbers that investors typically look at. Transactions up 10% to 6.1 billion. That's just looking at how many times are people actually interacting with their payment infrastructure. Payment volume is on a dollar basis, up 11% to 377 billion. And then you can see the take rate on that is actually relatively low because revenue for PayPal was only $7.3 billion. What makes PayPal unique in a lot of senses from a lot of other companies is that they have two sides to their business. One is the merchant side and the other is the consumer side. So as a consumer, you probably use things like Venmo or the PayPal app. That's what you're seeing over here. Debit cards, credit cards, Venmo falls in this. As a merchant or a business owner, what you would interact with PayPal with is this: processing, risk as a service, merchant lending, invoicing, in-store checkout, all kinds of things like that. That is a total other side of the business. And one of the arguments for PayPal is that they have both of those sides, and then the network can bring those two together. So PayPal Credit, it can actually lower some costs on some of their transfers. They have checkout, buy now, pay later, all kinds of other tools that they can use to tie these two things together. From a strategic standpoint, this is what separates PayPal from some of its other competitors. One of the things that investors might be looking at is the decline in free cash flow over the past year. You can see that free cash flow has been in decline. I want to note that this negative number in the most recent quarter includes a $1 billion impact from European buy now, pay later loans originated as held for sale loans. This gets into some accounting things that go on behind the scenes, but basically the company needs to hold these assets as held for sale. And then since they're selling them, they will actually see a gain on that sale when the sale closes. This is the adjustment for held for sale impact. So you pull this out and you're still seeing a decline in the last year, but maybe not quite as much as it seems without that adjustment. So why does it seem like there are some declines in the business? Well, this is the reason right here. If we look at take rate, this is basically the percentage of each transaction that PayPal is actually generating in revenue. it's a very small percentage, and a single basis point or 0.01% of the transaction is actually really meaningful for the business. So you can see that over the last year, the take rate on a total basis has been in decline to 1.94%. Transaction take rate has declined pretty sharply from 1.85% to 1.74%. There are a number of reasons for this. One thing is that management has gotten really aggressive in trying to grow the Braintree side of the business. That's basically the white label transactions. If you interact with Braintree, you probably don't even know that you're interacting with them because it operates a little bit like Stripe or Adyen in the background. The problem there is that PayPal isn't able to command a lot of money because they're going after typically higher volume customers that are going to be able to negotiate in a lower rate. So that's why we're starting to see these margins decline. Transaction margin as well declined from 51% to 45.9%. On a value basis, if you're looking at free cash flow to market cap or price to earnings, it looks like PayPal is very attractive and the company is still growing revenue. The concern is that we're starting to see deterioration in margins and free cash flow. And that's in large part because competition has gotten really fierce in the payment space. I mentioned Stripe and Adyen. There are dozens of players in the market who are going after that merchant solution side. What separates PayPal and what I think could ultimately add more value is the fact that they do have that consumer side of the business. And anytime they can connect those two, that's an opportunity to generate higher margins than they're going to collect by just being a merchant provider. But that's really the fundamental challenge in what investors don't know a lot about right now. How competitive are these companies going to be with each other? Because we saw Adyen fall recently because they had a terrible quarterly report. Stripe has had its own struggles. It seems like everybody is cutting their prices as much as they possibly can to get to a point where there's not going to be much margin left in the payment business. At the same time, we just heard that some of the credit card companies are increasing their fees. So they're taking more out of the pie. I think PayPal trades at such a value that shares are actually getting interesting at this point. And one of the reasons that they are is because they're one of the few companies that have the ability to find an alternative to the credit card companies that take a vast majority of the fee from these merchant transactions. But that's a disruptive solution that may take many years to play out. In the meantime, the company is going to have to continue to try to generate as much cash as it can from its existing business. I think that's a point of strength, but it doesn't seem like there's a lot of certainty in the market right now. My thought right now is that PayPal is trading at such a value that it's a good buy for investors. You need to understand that there is a lot of uncertainty in the market. But what do you think about PayPal right now? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.